Joining us right now to take a look at the impact is former IMF, International Monetary Fund chief economist and Harvard University economics professor, Kenneth Rogoff. Ken, it's always great to see you. Thanks for being here this morning.
Thank you.
Are we in a recession right now, do you think?
No, I don't think we're in a recession with this kind of job market that we have at the moment. But the economy is markedly slowing, and if the Fed is determined to get us there, we will.
Yeah, I'm just wondering if, this sell-off in the price of oil has to do with these expectations that we're seeing this sharp slowdown in the macro story. I mean, if you believe that things are going to slow real fast and pretty significantly, you believe oil prices come down, right? Or is it a different scenario because of the supply-demand dynamics of not a lot of supply of energy, oil and gas here from America?
Well, first off, Europe is in worse shape than we are. They have the energy problem, dependence on Russia, and they're, facing the cost of the war much more. So that's also a part of the global oil story. And maybe China's not picking up quite as fast as some reports are saying. So the oil's a globally determined price. But, the United States still has this very high inflation and very strong job market, where I think I feel some, strong conviction is that the Fed's not going to get its wish of a soft landing. And I'm betting they're going to blink, but I don't think they're going to be able to bring inflation down to target within, say, the next year, year and a half, and not have a pretty big recession.
I mean, how important is the performance of the stock market? Alan Greenspan, as you know, used to talk about the wealth effect. This morning, futures are searching for direction because we're waiting on the Federal Reserve minutes. And, of course, yesterday, late in the day, we saw a technology rally, and that sent the major indices ending mixed, with the NASDAQ strong after a 30% sell-off in the first half of the year. What are you expecting for the second half of the year in terms of the macro story and the stock market, Ken?
Well, the stock market, when it falls this much, is certainly feeding back into the economy. It's affecting investment. It's affecting, firms, animal spirits. It's affecting consumers who are looking at their 401k. So absolutely, it's significant. It's not the whole story. What happens next, Maria? I don't know. I would say it's fallen a lot. And so, yeah, it can fall more. But obviously, I think if the Fed blinks, as I suspect they will, they don't raise interest rates as much as people think they're going to at the moment, then maybe, it has room to go up.
Well, let's face it, the Fed did blink on the 75 basis points, right? I mean, right before the meeting, Jay Powell told us the 75 basis points is not on the table. He said in that Q&A period, and then a couple of weeks later, he raised his rates by 75 basis points. We're expecting another 75 basis point hike at the end of July. What are you expecting? You think that the Fed, you say it's not going to achieve this soft landing. How severe might a recession be then?
Well, right now, if you listen to what they're saying they're hell-bent on bringing inflation down. And in the long run, no matter how much it hurts, that's really good. We hope it won't be so bad. When I say they're going to blink, I think they're not going to end up raising interest rates as much as they say they're going to. At the moment, I have to say they're doing a great job talking down the long rate while saying they're going to raise the short rate. But, as much as President Biden's going around saying inflation's the number one thing on his mind, it won't be once a recession kicks in. I'm worried they're going to take one mistake, both fiscal policy and monetary policy having run the economy much too hot, and go in the other direction, as step on the brakes too much. I have to say, it's kind of amazing. I'm reading progressive economists who not long ago were saying we have to have helicopter money. We have to have the Fed printing money and give it out to everyone. We're suddenly saying, oops, maybe we did too much and need to slow down. I think there's this chance they overshoot in the other direction.
Well, there was all that free money, $1,400 checks, $300 child tax credits.
Oh, yeah.
All of that money sent savings rates higher. But now consumers are cutting into their savings accounts to deal with this higher inflation, Ken. When you look at the growth of this country right now, we're 2 weeks away from earnings season in the second quarter. What kind of a second half are you expecting? You're right. The market has been reacting with violent moves when the Fed makes its move. So maybe a wild stock market and a major sell-off stops the Fed from doing much more at some point. Do you see growth at all in the second half of the year, and where is it?
Yeah, I'm guessing, there's been this big negative inventory adjustment that's driven the Q1 and appears to be driving the negative Q2. So there'll probably be some give back in that. But nevertheless, that doesn't mean inflation's coming down. And the Fed's going to be looking at that. That's still going to be out of control for a while. I don't think they're going to get it down quickly. I don't think the supply shocks from the energy, food, everything else are going away. They probably will get worse before they get better. We have inflation going on all over the world right now. There's a very strong impulse. So no, I don't think the Fed's going to blink yet. I think I think they're going to do is raise interest rates maybe to 3%, even to 3.5%, but it might not be enough.
Yeah. All right, Ken, we'll be watching. Great to see you as always. Please come back soon. Kenneth Rogoff joining us this morning with a market that is off of the lows, down about 10 points on the Dow. Thank you, Ken.